Hi there, it's Nick Carlisle from Platinum Portfolio Builder, and I can't believe I'm talking to you at the end of 2013. It hardly seems 5 minutes ago since I was doing this previous video about the predictions for 2013. And what I want to share with you is our predictions for 2014 with regards to UK residential property investment. Now we're going to go through the same headlines that we went through in 2013. So the first is obviously prices. It's the thing that most people that we talk to want to know about. Now in 2013 we said that prices would change very little during the course of 2013. Now official figures up to October, which is where the figures have been produced up to, actually showing a 3.1% growth across the UK, but the majority of that has been in London and the rest of the UK has stayed fairly stagnant. Now 2014, our predictions for prices are that London will start to slow, albeit there will continue to be growth in London. London to me seems a little bit bonkers. Yields don't work, it's very difficult to get prices. But if you believe that London is always going to go up in value, which I don't, then that might be a good place for you to invest. We believe that to get the best investments, to get yields which are going to give you good income and to get significant discounts, then you need to move further north, and we think that 2014 is going to start to see better growth outside of the capital. And the reason for that is these four things that have been aligning over the last couple of years. So the first is supply and demand. That's a given in UK property. You've heard me say this before. There's always going to be demand for housing of the right kind. Affordability for normal people to buy property. This has been helped by the Help to Buy scheme with the government, and general affordability is heading in the right direction. Lending has started to ease up significantly, which I'll talk about a little bit later. And then overall confidence in the market, not just the property market but the UK economy as well. So those four things are starting to align, which means that we'll start to see growth in 2014. Now we don't think it's going to go to the moon. We're sort of predicting single digit low numbers, sort of 2, 3, maybe 4% growth across the UK for 2014. In 2013 we talked about the areas that would work, and we said that London would continue to recover, which it has. It's recovered beyond all expectations. Prices continue to rise. Lots of foreign money coming into the capital, and there's just a real hype and a buzz about London. That means that prices just continue to go up and demand is really high there, but yields are in the low numbers, you know, 2, 3, 4% gross yield if you're lucky, and it's very difficult with the competition in London to get a decent discount. And as I said, if you want to find deals which have got double-digit gross yields and significant discounts, and the areas that are going to work are going to be further north. So where we invest in and around South Yorkshire, across to Manchester, Leeds, Sheffield, Liverpool, some of these big cities that have got significant investment going into them, but where you can still get discounted properties and you can still generate income on a monthly basis from your investment. So you're not just relying on this future growth that may or may not happen. In 2013 we talked about lending and said that this would ease up, and it has, as we predicted. It hasn't quite eased up as much as we would maybe like, but there are more lenders and there's more competition in this space that want to lend to property investors. They're starting to focus on more professional investors. The accidental landlord, it's very difficult for that kind of person, that kind of investor, to get lending. The Help to Buy scheme is obviously helping. Government-backed lending is going to put more people into the market, and the lending, if this continues to change as it did in 2013, this could be the single biggest difference to the UK investment market, that as lending starts to ease up, more people come into the market and then prices will rise. And we've started to see some of the lowest rates ever, starting with a 3.4, 3.5% on buy-to-let mortgages from some of the high street lenders. But as I said, they want to see a business case for the properties. They want to see professional landlords doing it, or potentially working with companies like ours that put a lot of business their way. 2013, in terms of regulation, more and more changes to the benefit system, still a lot of uncertainty in there. We made a conscious decision a while ago to move away from housing benefit, local housing allowance type tenants, and we've continued to do that and to increase gradually the types of the value of tenants that we attract into our properties, and the higher value properties that we're now starting to buy still coming with significant discounts. And there'll be more regulation in lending in 2014, and it's going to mean that investors have to jump through a lot more hoops, but by working with brokers who know this market and who know the lenders, they can help you get property transactions and lending through in record time, because it is the speed that is going to give you access to the great deals. 2013 interest rates, we said that by the end of the year they'd still be at less than 1%. We've got a little way to go yet, but I think I'm safe to say that they're going to stay at where they are at 0.5%. And in 2014 we don't see much change. We're actually predicting that interest rates will rise, but by half of 1%, maybe a quarter of 1%, at the most 1% growth, but we see that as being fairly unrealistic. Mark Carney said that interest rates wouldn't rise until unemployment reached 7%, and at the time he stated that, we were at 7.7. Now that has come down, and it's coming down quicker than he first predicted when he said that that unemployment would reach 7% in 2015. Most people think that that's going to happen more quickly now, and it will have an effect on interest rates, but at worst case we predict that interest rates at the end of 2014 will be at 1.5%, and it's not really affecting the cost of borrowing from an investment point of view. And if you're buying the right stuff with double-digit gross yields, then there's clear headroom in there to cover that, and you can of course fix interest rates as well. 2013 we talked about competition growing within the investment, lots of more small investors coming into the market. We've seen it here. We've changed our business model, going from buying lots of individual properties, because the competition for those smaller deals is starting to hot up and prices are starting to rise in that. So to get the better discounts, we've moved our business model, and instead of buying average purchase price of about 60,000, we're now buying blocks of properties, portfolios of properties in the price range of £250,000 upwards. And for £250,000 you can buy a block of six properties with a double-digit gross yield and a discount of about 25%, because there's less competition in that space than in this space here. So that's what we will continue to do during 2014. In terms of what will work in 2013, we said it's the dull and boring stuff that will work. You know, no major predictions here. That's what's always going to work. What will always work is the dull and boring stuff, the safe, the solid, the reliable, safe housing that people are always going to want to live in, they're always going to want to rent. We talked about HMOs at the start of 2013, and we predicted that more and more people would come into HMOs, into houses of multiple occupation, and that has certainly happened during 2013. There's been loads of variations on HMOs, ranging from a straightforward purchase and tenanting through to lease options and rent to rent and multi-let without the sweat and all of these things. And what it's done is it's put more competition into that space. It's meant that some areas are starting to get oversaturated with HMOs, particularly in and around London and the South East. Some particular areas massively oversupplied now with HMOs. And the truth is, it can be a great strategy if you pick the area, but with the kind of deals that we can do, if you can buy properties with discounts of 25 to 40%, if you can get double-digit gross yields, then those properties can give you as good a return as a HMO can, because the mortgages are cheaper than HMO mortgages. The management is much less costly and much less intense. The hassle factor is much less than on a HMO. And as I said, competition in HMO space is growing and will continue to grow during 2014. So it's a safe, solid, simple single AST properties where you're buying them in bulk, where you're going to get the best returns during 2014. Development properties are starting to make a little bit of a comeback, and in a few years' time you'll need to do development if you want to get those kind of discounts, but at the moment you can buy property that's ready-made, that's ready tenanted without the hassle of development. And what's going to be absolutely key during 2014 is speed to do deals. So what you need is a legal team that can move quickly. You need finance that can move quickly in a space that traditionally moves fairly slow. You need lettings to be able to let the property for you as quickly as possible. And if there's refurbishment, all of that needs to be done as quickly as possible to get the best out of your investment. And that may be where Platinum Portfolio Builder can help. So if you want to come and see us, please feel free to. We have open days in our Yorkshire office. We're in London almost every week to meet clients and prospective clients, and I'd love to spend some time with you during 2014. Thanks very much for listening.